This is Pat O'Meara. I'm the chairman and CEO of Inveniam Capital Partners. It's good to be with all of you. Thanks so much for joining us. I'm super excited to be with the security token markets folks and everybody else who's a participant. This is a fantastic event. The speakers are amazing, and I'm honored to be among them. I want to start just by taking a minute as it's been a big week for a lot of different things. We have employees in Israel. We have shareholders in Israel. And I know this isn't the typical way to start, but I think we need to acknowledge the reality on the ground that there are a lot of people hurting who are defending themselves, protecting themselves against really unspeakable acts. And what I'd like to do is maybe take a moment and ask everybody, I know everybody prays in a different way, to just have a moment of silence where we pray for Israel and their defense and all the victims of this past week. So I'm just going to take a moment to do that. I want to thank everybody for joining me in that as we pause for Israel for a minute. And we're here to talk about tokenizing real world assets and the state of that. And in Inveniam, we play a critical role in allowing multiple parties across the ecosystem in a cross-enterprise service bus or process automation where everybody's looking at the same data. And, we have a very technical function, everything from the asset to the token, right? We are facilitating everybody looking at the same piece of data so that if we're going to have real world assets trading, we're not building the world's largest referenceable database in the middle, but we're creating financial instruments that can surveil assets at the edge. And that's a technical thing that we do. Then we have some really cool tech. We've been around for a little bit. We've got about just under 80 billion of assets on our platform. We have over 70 patents. So we've got some really cool things that are going. But I want to remind everybody why we're doing this, right? And that's really the topic. The topic is, why does real world asset tokenization matter? And the reason is, if we think about banks and the role that they've played really for the last 650 years, they have played as an intermediary of trust between individual parties, individual corporations, individual cities and policies, individual states, where the mechanism moving beyond barter was a massive shift. And the role that banks have played, where you could deposit your excess capital and that could be deployed to a third party, and everybody agreed to a certain set of rules. I'm going to deposit the money. The bank acts as the intermediary. They deploy that capital that was invested in innovation, expansion of means of production, civil infrastructure, sovereign infrastructure, technology innovation, whatever it might be, over the last 650 years. And that has been massively impactful in spurring creation and innovation. And these banks acted as a middle intermediary function for that, both to originate deals. They were the arbiter, understanding risk, managing the risk on behalf of the depositor. And what happened is capital markets developed, and there were commercial banks and investment banks, and those investment bankers were structuring things that bankers were involved in, and then other asset managers came in. But at the end of the day, the primary denomination of that thing in which you stored your value was a dollar, a euro, a won, you name it, right? And the British pound, right? Whatever it might be. And you stored your value in that thing. You deposited it or you invested it. And even if you deposited it, it ended up being invested, but you were really taking the enterprise risk of that bank. And in today's day and age, the government for most banks who are backing banking, which we don't want to talk about the moral risk inherent in that, but this is an issue. And this banking structure spurned an enormous amount of growth in a large part of the economy. The problem is there's a whole part of the economy that wasn't there. And how do we expand the ability to spur innovation, creation economically for people to feed their families, for them to be the primary agent of change in their own life? And this blockchain function. Crypto is a version 0.2 of blockchain, right? I heard that as Bitcoin is blockchain 0.2, 0.1, and we're starting to get 0.3 and all these kind of other functions, but full on blockchain, a tokenization of real world assets, tokenization of securities, where we're tokenizing pieces of the capital stack. I'm really going to say that's 1.0. And we're not there yet. We're getting there. But we're tokenizing real world assets, and we're allowing people to invest their money into a real world asset that will inflate along with the currency. Why does that matter? Because when you're a saver, which is the large part of the middle class globally, and you're a cash saver, you're a native currency saver, right? So you're saving in there. And then that central bank is printing, and there's a monetary policy that is not advantageous to you as a saver. Your savings are deflating every month, every year. We saw massive printing, right? We can talk about, the M3 that's out in the market, what the Federal Reserve did, quantitative easing, and they gave it many other good names, right? To mask the printing of this money that's deflating the value for the cash saver. Now, if you were an asset owner or an asset creator, this inflation, you're protected. But if you're not, literally the middle class and really the lower middle class and the poor are getting hurt the worst. And what we're seeing is an evolution from 650 years of banks being the primary mechanism by which excess capital is distributed for the innovation and creation of economic means being created by individual actors, corporations, entrepreneurs, technologists, governments building infrastructure, to now this global economy where the internet is connecting the supply chain, and we're moving beyond this concept of what's the cheapest place for me to create this thing, this widget, and then I'll ship it everywhere from there, right? To what is the cheapest place for me to deliver the quality widget to the degree it wants to be used. So it's locally sourced, it's organic, it's farm fresh, it's whatever it might be, right? There's no blood diamonds, there's no conflict minerals, whatever it might be. What is the mechanism to deliver that unit to you in the cheapest manner? Now, that global supply chain where the internet has transformed how we think about the economics of delivery, we're also rethinking with blockchain and Internet of Value how we can deliver my stored value to somebody who wants to use it in this next iteration, where we don't need an intermediary oracle of a bank, where the medium needs to be a currency. And instead, to the degree that we can begin to tokenize a real world asset, and that tokenized real world asset has daily, weekly, monthly, quarter liquidity based on good data using Inveniam, and we're great and all that kind of good stuff. But literally what happens is we change store of value. Why does that matter? It allows people to access the capital markets in new, innovative ways where there are not choke points that are controlled by the incumbents who are extracting rents, right? And when we think about financial models, right, I think when there is confusion, there's a profit. That's been a financial model for banking for years. Or where there's complexity and confusion, there's profit for these intermediaries. And what we're doing is using the blockchain as a mechanism to commute trust in I'm investing actually in an asset. And not only am I investing in that asset, so my paycheck is going into multifamily housing. My paycheck is going into a light industrial warehouse. My paycheck is going into commercial real estate. It's going into infrastructure assets. It's going into a portfolio, assets that are inflating. And as long as I can connect that to my MasterCard and I can buy my latte or I can pay my electric bill, et cetera, the role of a bank and a commercial bank is not going to go away, but it's going to change dramatically. Change 100% inexorably, where banks are going to play a role but they're not going to be that central intermediary. And this is what tokenization of real world assets is doing. It is allowing for a store of value that if we pair that store of value with real-time data and a third-party oracle, and then we attach that with a liquidity function, think of it as an AMM with a pairing of the equity and some type of digital USDC or whatever it might be. And then we can price that asset once a day by a trusted AVM that has a monthly mark for a real estate asset that's done by somebody like a Cushman and Wakefield, who's an oracle that's trusted. Or if we want multiple oracles, we add Regan JLL or CBRE or Houlihan Lokey or Mercer or Deloitte or name somebody. All of a sudden, we have these needed elements where I can trust that my wages that I earn every 2 weeks are being stored in that. And as I'm storing in that, and I'm not a cash saver in an asset that is deflating in value because of monetary policy. Now, we've seen this in Argentina. We've seen this in Zimbabwe. We've seen it in Venezuela. This is how Daniel Ortega took control and created one of the largest middle classes in the Western Hemisphere. He destroyed by printing massive amounts of currency and destroying that middle class instantaneously and stirring up conflict in order for him to maintain power. And what we're going to do is we're going to see people being able to store their value away from risk, perceived or real, and participating in a global economy. And now the dollar's not going away, the euro's not going away, the pound isn't going away, but they are going to exist in a world where Bitcoin is next to it, and Bitcoin Cash and Ethereum and those kind of type of utilities. But not only that, we're going to be able to go in, and I'm going to be able to facilitate a 10,000 unit multifamily housing where each one of those assets is being repriced. I own a piece of that. My paycheck is going direct deposit directly into that, hitting an AMM. And then that's connected to a MasterCard, and I can buy my latte, I can pay my electric bill, I can buy my groceries. Now, when I need a line of credit or I need something that is pure real world, maybe I will have to go in and get a mortgage in order to construct an asset for a construction loan. And eventually, even that, we're going to start to see new types of DeFi protocols that are going to be developing. And this is when DeFi plus traditional commercial banking and mortgage banking is going to be integrated, and an asset owner is going to be able to take their asset, put it online, credential their data. That performance is going to be able to be seen real time. They're going to be able to say, what's the cheapest source of capital for me? Is it a traditional bank? Is it me going into the capital markets, going to the institutional, or can I directly tap a DeFi protocol? And if they do tap that DeFi protocol, you need more than just, Web 1.0 technology going to an oracle who's then giving you a number. You need actually the ability to surveil that asset real time. And what this does is it changes fundamentally the role and what we use to commute trust. And we're able to access data. And you might be, instead of going to JP Morgan to store your value, you might be going to a new type of registered investment advisor. Trust banks are going to develop. You're going to see Wisdom Tree and all of their innovation where you're going to them and you're direct depositing into those assets. But not only that, you're going to be able to go into local developers where you say, oh, I want to invest in that asset. And, one of the things that we've seen in the development, we had around 200 stock exchanges in the United States 100 years ago. And we literally had 6x the number of public companies. Now, the size of those companies were much smaller, but Minneapolis had a stock exchange, Denver had a stock exchange, Salt Lake City had one, San Francisco did, et cetera. And all of these smaller local firms were there. But then the big exchanges bought up all the small ones. And what it did is it raised the bar of how big you needed to be to get listed publicly. And why is there an advantage of being listed publicly? Because lots of people can participate. People trust the exchange. There's a finality to that trade and that settlement that when I buy on an exchange, literally, even if there's bankruptcy, they're not going to come back and claw that back. We're on an OTC desk. That judicial finality isn't really there. And even though we can use an atomic swap, we're still going to need to have these exchanges that produce judicial finality that are going to allow people to get into then this next version where we don't have one stock exchange and you got to be a giant to get there, but different levels of reporting and data so that people can have trust in the source data. They can see it real time. They've got oracles that can define them, just like a bond, right? When you go in and you're buying some bonds, that bond is denominated. Is it investment grade or is it junk, right? Or non-investment grade. You get a Moody's, an S&P, a Fitch, who help you understand where that bond is. The bond funds are denominated by that, and then they literally buy. There's going to be new denominations where we're literally buying real estate, and it's going to be denominated by Cushman & Wakefield. I'm going to buy this type of asset that Cushman & Wakefield denominates on a monthly basis. There's marks given, there's AVMs on a daily basis. But literally, as that then begins to move, we can all of a sudden start to see mechanisms for daily, weekly, monthly liquidity. I'm getting in and out of these assets real time. And I'm using these real world assets as stores of value. And I'm going to different intermediaries, what would have been 100 years ago, the Salt Lake City or Denver Stock Exchange, but where we're going to go to somebody who is the next incarnation thereof, an Oasis Pro, a Rialto, right? Some of these other new exchanges. We're going to a tokenization platform that's going to not only technologically deliver you the ability to tokenize with the needed information, but with the financial expertise to help you understand who the right buyers are. And as we develop this, the data is going to develop where you're going to reverse engineer the capital stack. If I'm a developer in Topeka, Kansas, or in Kuala Lumpur, or in Bangkok, to institutional buyers. And I'm not just going to see what are the 5 comps in that local neighborhood. I'm going to see what are the 5 comps in the top 85 MSAs or metropolitan statistical areas that are correspondent to that in those countries. Meaning, I understand, if I'm going to finance a building in Eden Prairie, Minnesota, right? What is the nature of that suburb in relationship to Minneapolis, St. Paul? Most people don't. I understand what Rochester Hills is to Detroit, right? I understand what Far Hills or Summit is to New York City, or Greenwich is to New York City. But the reality is, if I'm in St. Paulo, I don't. Or if I'm in Greenwich, I don't know what those right neighborhoods are in St. Paulo or Kuala Lumpur. Now I can get those 5 local comps by a local real estate appraiser of the 5 buildings in Kuala Lumpur, but then we can start to see partnering with these large language libraries and this large compute function of people. Give an example of Inception out of the Middle East with their massive, 4 exaflop computer, that they're not only going to be able to say, okay, here's the correlations, ASC 815, to these other assets and all these MSAs. And what that does is it gives the local investor the ability to trust and understand and relate that. But not only that, with those correlations, and we're seeing these little trades and all of these pieces, that's the basis around which markets, where you don't need a guy picking up a phone and saying, hey, Jimmy, I got a bond, let me tell you about it. But all of a sudden we have this going. And the reason we see things like our friends at please, I have a question coming in. Sorry, I'm not paying attention to those as much as I need to. As we see all of this data being created, what we're going to see is markets that historically have been inefficient becoming far more efficient. I'm going to give you an example. I like to say that the secondary market for taxidermy is more efficient than the secondary market for high yield bonds. And the reason is, if my wife gets sick of the moose head above the family room, above the fireplace in the family room, she's going to say, get rid of it. It used to be 30 years ago, I would hang a sign on the moose head and say, $400 OBO or best offer, right? And I'd put it out then my driveway or on a street and hope people saw it, or take an ad out in a local newspaper. Now I go on eBay and I can see what is the clearing price of a moose head. There's good data on the quality of that moose head, and literally I can price it and it'll be sold and gone in 2 days. That type of data and that type of correlation doesn't exist in high yield bonds in relationship to the security package of that piece of the capital stack in relationship to that underlying asset, particularly because the data lags. That data has typically been gathered and collected by a servicer and delivered. And what we're doing is, by literally speeding up this chain, real-time surveillance under the underlying asset, we're going to make the markets more efficient. We're going to be able to price the assets. And as we do so in this automatic market making, we're going to have this ability to change store of value. And this is going to bring about a new mechanism to broaden or democratize alpha, right? Where are we finding value? And right now, people only look for alpha on a real estate basis, if you're a big pension plan, only in the largest MSAs in the world, because you can't deploy money in size. Does that make sense? And so what we're doing is this role of a bank as the primary intermediary changing. And what we're going to do is we're going to see this automation of middle and back office function, transfer agents, security agents, capital calls, expense allocations, the custodian function, all of these, we're going to be automating the interaction. Everybody's looking at the same piece of data, and across an enterprise or across an ecosystem, we're going to see enterprises collaborating on the same piece of data in order to service an asset pre and post trade, giving that price discovery. And as we do that, we're going to see interoperability on chains. We're going to see markets come together. We're going to see the aggregating of liquidity across silos, but also we're going to see more robust nature where pension funds are going to be able to invest in their own states and their own cities and their own developments. And the problem is, you have somebody who wants to build a $50 million asset in Tallahassee, Florida. There's no way the Florida State Board is going to have access or see that in any way, shape, or form. But to the degree that they can post and say, we're going to fund projects that look like this, that person's going to be able to reverse engineer and literally sell on an automated basis into that and have part of his capital stack filled. This is a data-centric, decentralized capital market structure, which is coming. But it only works if we have good data on the underlying assets. I want to also say that's only going to work if we are not trying to anchor every piece of data onto the chain, right? And we talk about this all the time, right? In Boolean algebra, there's 4 functions, there's variables, there's constants, there's operations and relationships. We believe relationships and variables need to be in smart contracts, and operations and constants probably are off chain. Now, some constants will be on chain, right? So every pricing model for every trading book in the world, they think they've got the best pricing model. They're not going to put that on chain. They're going to want to price their own options, et cetera, because they think they've got a proprietary, better than everybody else pricing model. Some people won't care, and they'll use an open source one, an open AVM, and they'll price that themselves. Those are, think of those constants. And what we're doing is we're showing here through a zero knowledge proof, this is the data that went in, right? This is the source of origin. This is the proof of process, a proof of output, right? So this is the data that went in. This is the data that went out. And 5 years from now, we're going to be able to prove that that calculation, which was open sourced anyways, right? If it's in a smart contract, and if it's up above, you're trusting the brand, and they're going to be able to prove to you this was our calculation engine. Even if they don't show it to you, they're going to be able to recreate the calculation, because we're going to prove this was the state of data that went in. And what we're doing is we're seeing this automation of functions. And as we see these functions being delivered on-chain and off-chain, we're going to see interoperability develop. We're going to see us living in a multi-chain world, and we're going to see banks providing credit as a primary function, but not as a gating function. We're going to see them as a mechanism of on-ramp and off-ramp to payments. But really, that's the story of where we're going to be. So we have one question here talking about where banks will be in post-2050. I think banks that own relationships with their customers, and they own those relationships digitally, and the custodial and the wallet function is going to be paramount. I think banks that people are going to trust, who are going to service assets, and they're going to trust that brand for the servicing, who are going to act also as an oracle on pricing, those guys are going to be around long term. The role of a bank post that, it's going to transform. and the role of trust as the intermediary between polis, corporation, person, states. That 650-year run, it's coming to an end. So I don't know if there's any more questions for me. I think I'm coming up pretty close on the end of this. I want to remind everybody that when I'm done, there's an event. We're asking everybody to go to the booths that exist, and there's going to be a networking session, and we invite everybody to go to that. But Jason, I don't know if I've got any other questions that have come in for me. If there are, I'm happy to answer them, but I think we're coming up on the end of this. And boy, it's been great to have everybody with me.
Absolutely. Thank you so much, Pat, for your insights here, and everyone for joining in, asking some questions, and a great session here. So yes, as Pat mentioned, we do have our networking hour coming up shortly right after this. Please join us in the expo floor. You'll be able to see each other around the floor based on where your mouse is. If you hover over someone, you can even set up a Zoom call to meet with each other. We also have our sponsors booths where you can meet with each of the sponsors, learn more about them, ask them about what's going on in the markets from their points of view directly, and see if there's any room for collaboration as well with you and your firms. STM as well. I know some of you were looking forward to our STM Insights. We will be hosting those in the STM booth as well. So go ahead and join us there directly. And we'll be having a nice little conversation on what we're seeing in the markets. And thank you all. Pat, thank you for your time. And that concludes this session.